The trade is down 40%. You have checked the chart a dozen times today. The position is wrong, and part of you already knows it. But you do not close it. You tell yourself the market will recover. You tell yourself the thesis is still intact. What you are actually doing is refusing to accept a loss that has already happened. That refusal is not a strategy, it is one of the most documented traps in behavioral finance, and it costs traders far more than any bad entry ever could. I know that voice. There was a period where I held a position far too large for my account, trading against a strong trend. Every session I told myself the market would recover. It did not. A large position held against a strong trend does not give you time to adjust. The drawdown compounds faster than any recovery can match. The worst outcome is not just losing money. The worst outcome is losing the ability to keep trading at all. The Stoic philosopher Marcus Aurelius wrote about the danger of attaching yourself to outcomes you cannot control. A trade moving against you is not failure. Holding it past every exit signal because you refuse to accept a loss is real. That is where the sunk cost fallacy takes over. That is the moment you stop trading and start hoping. The data on how traders manage losing positions is consistent across markets and decades. Individual investors hold losing positions roughly twice as long as winning ones. Researchers have given that pattern a name, the disposition effect, which describes the systematic tendency to hold losing trades while selling winning ones too quickly. The psychological engine behind it is the sunk cost fallacy. The logic feels reasonable on the surface. You put real money into this trade. Closing it now locks in a loss you might still recover from. So you hold and the position drops further. The reasoning does not change. If anything, closing now feels even worse. The number you are trying to recover has grown. This is the trap. The money already lost is gone regardless of what happens next. That is what makes it a sunk cost. The past expense has zero bearing on the best decision available today. But the brain does not process it that way. It treats every open position as a vote cast for a future outcome. Closing a loser feels like admitting the vote was wrong. Most people avoid that admission as long as possible. The numbers are not subtle. Studies of individual brokerage accounts show that retail traders close winning positions about twice as fast as losing ones. In any given month, winners are sold far more often than losers. That asymmetry is not coincidence. It repeats across millions of accounts. Different markets, different experience levels. The pattern is behavioral, not strategic. The cost compounds quickly. A trade held too long does not only lose money in isolation, it ties up capital that could be deployed elsewhere. It consumes mental energy. It distorts the next decision. A trader managing an underwater position is not making clean, independent choices. Every new opportunity is evaluated through the filter of an unresolved loss. The academic case for the sunk cost fallacy dates to 1985. Hal Arkes and Kahneman Blumer published a paper titled The Psychology of Sunk Cost that year. Their experiments produced a clear result. People consistently allowed past investments to shape decisions that should depend only on future value. Their most famous experiment used ski trips. Participants were told they had purchased a weekend ski trip at full price. Shortly after, they purchased a second trip to a different resort. The second trip was cheaper but less desirable overall, which made the rational choice seem obvious. Both trips then fell on the same weekend, and only one could be taken. The majority chose the expensive trip rather than the better one. The past cost was controlling the decision, even when the optimal choice was clearly visible. The mechanism connects directly to loss aversion. Kahneman and Tversky established through prospect theory that losses feel roughly twice as painful as equivalent gains feel positive. That asymmetry creates a powerful avoidance instinct. The brain treats an unrealized loss as recoverable. Closing a position forces realization. Holding preserves the fiction that the loss has not fully happened yet. Richard Thaler built on this through his work on mental accounting. He found that people mentally place money into separate categories, and those categories are not interchangeable in the way pure math would suggest. Money committed to a losing trade occupies its own mental account. That account does not close until the position closes. As long as the trade is open, the loss remains theoretical. The brain resists settling the account, because settlement means accepting a final real number. Fowler also documented what he called the endowment effect. Once people own something, they value it more than they would if they did not own it. For a trading position, this means the mere fact of holding a trade increases its perceived value relative to what a neutral observer would assign. The trader is not evaluating the asset. They are evaluating their ownership of the asset. These are fundamentally different calculations. The endowment effect inflates what the trader believes they are owed by the market. Hirsch-Shafran and Meir-Statman named a trading-specific version of this behavior in 1985. Their paper studied individual brokerage accounts and confirmed the pattern directly. Investors sold winning positions significantly more often than losing ones. Adjusted for all reasonable alternative explanations, they named it the disposition effect. The word disposition was deliberate. It refers to a systematic tendency, not a random error. Terence Odean at the University of California at Davis extended this research across more than 10,000 brokerage accounts. His study covered a 7-year window. His main finding was direct. Investors sold winners about 30% more often than losers in any given month. When the research controlled for tax considerations, the pattern actually strengthened. The behavior was not strategy, it was psychology. Odean found something else that compounds the damage. The stocks investors held too long, the losing positions they refused to close, underperformed by an average of roughly 3% in the following year. The trade they clung to was not just a current loser, it was the weaker asset going forward. The sunk cost fallacy did not only delay the inevitable, it locked traders into the consistently inferior outcome. DALBAR's annual quantitative analysis of investor behavior shows the cumulative effect of these patterns over long periods. Their study, ending in 2023, found a consistent result. The average equity fund investor earned about 6% per year during that window. The broad market index returned about 10% per year over the same period. That 4% annual gap compounds to an enormous difference over time. Behavioral patterns, not bad market timing alone, drive most of that gap. The disposition effect is one of the primary contributing factors. These cases are composites based on documented behavioral patterns, described anonymously for illustration. The first case is a trader with 2 years of experience. He entered a technology position expecting a short-term recovery after an earnings miss. The stock moved against him immediately. He held through a second quarter, waiting for the next catalyst. It did not arrive. He held through a third quarter report. That disappointed too. He held for over a year. His eventual exit was at roughly 60% of original capital. When he reviewed the trade afterward, he found something specific. He had correctly identified 3 strong opportunities during that year. Each time, the capital was not available. It was tied to the losing position. The cost was not only the loss on that one trade, it was the 3 trades he could not enter. The second case involves a retail forex trader with a documented trading plan. She had a clear written rule. Any position that moved against her by 2% would be closed, no exceptions. She had backtested this rule carefully. In her first year, she followed it consistently and finished with modest positive returns. In her second year, she began making exceptions, each one carrying what felt like a valid reason. The first was justified by a specific news event, and the second by a technical signal she interpreted as overriding the rule. By the third exception, the rule existed only on paper. She finished that second year down significantly, with a clear paper trail showing exactly when the deviations began. When she reviewed her trade journal, the pattern was visible. Every winning trade was closed at target. Every losing trade was held past the original stop. The rules she broke were the ones that had been protecting her. The third case is from equity investing rather than active trading. A retail investor bought shares in a company based on a narrative he had researched carefully. The narrative turned out to be wrong. The company faced structural challenges that were not part of the original thesis. He knew this. He had read the reports. He acknowledged the thesis had changed. But he held for another 18 months, waiting for a recovery that made no logical sense given the new information. His stated reason, captured in his own notes, was that he had put too much time into the original research to close it as a loss. He was holding the position to honor the research, not because the research still supported holding. All three cases describe different markets and different styles, but the behavioral mechanism running through each account is identical. A past investment created a sense of obligation that had no rational basis, but the obligation produced entirely real financial losses. The sunk cost fallacy cannot be eliminated by understanding it. Research shows that traders who can accurately describe the bias still fall into it under live conditions. The solution has to be structural, not motivational. The first structural fix is the pre-commitment rule. You define exit criteria before the trade opens. A specific price level, a specific percentage loss, a specific time window. You write it down. You set the decision before you are emotionally attached to the position. When the criteria is met, the position closes. There is no real-time deliberation. The decision was already made under neutral conditions. The second fix is a single reframe question. Before holding a losing position for one more day, ask this. If you had no position right now, would you open this trade at this price, with this risk? If the answer is no, the rational action is to close. The only reason to keep holding is the past investment. And that is exactly the sunk cost fallacy in operation. Asking this question forces the brain to evaluate the trade on current merits, not historical commitment. The third fix is a structured journal practice. After every closed trade, document two things only: what you planned before entry and what you actually did. When these diverge, the journal provides a feedback mechanism. It shows the deviation pattern without requiring you to catch it live. Traders who review journals monthly tend to identify their own behavioral patterns within a few cycles. The fourth fix is position sizing. Keeping individual trades small enough to close without meaningful account damage reduces the psychological pressure to hold. The larger the position, the stronger the sunk cost effect becomes. Most retail traders who struggle with holding losers are also oversized for their account. These two problems reinforce each other. Smaller positions lower the emotional cost of following the rule correctly. None of these approaches is complicated. All of them require acting on the rule before it feels necessary. The sunk cost fallacy wins when given time. Every day a losing position stays open. The justification for holding strengthens. The time invested becomes its own sunk cost. The rule starts to feel like a technicality rather than the point of the rule. This is why structural pre-commitment is the only reliable defense. It removes the real-time decision from the environment where the bias operates. There is one last thing worth understanding about all of these fixes. They are not about becoming emotionless. The goal is not to eliminate the feeling of loss. The research is clear that even experienced professionals feel the pull of sunk costs. The goal is to build systems that act correctly regardless of how the feeling presents in the moment. Discipline without structure fails under pressure. Structure works because it does not require you to be strong at the moment the bias is strongest. This is not financial advice. All trading involves risk, and results depend on individual decisions and market conditions. The research discussed here is for educational purposes only. If any part of this felt familiar, leave a comment below. What was your longest held losing trade, and what finally made you close it? Subscribe to CashCinema for more breakdowns on the psychology and math behind financial decisions. Every dollar has a story.